Joining us is Heather Brilliant, CEO of Diamond Hill, which has $26 billion in assets under management. Good morning, Heather. Thanks for coming in.
Thanks for having me.
So the story of this year, I mean, if we can start to write it, I guess, is 20% gain in the S&P 500, more resilient U.S. economy than we might have expected, inflation coming down pretty fast, the Fed's on hold. Where does that leave us, or where do you think it does in terms of the risk-reward looking into next year with the macro and micro, of course, because it has been a very uneven stock market performance this year?
Yes, I do think it's been a situation where it's very hard to make macro calls from here, which is why at Diamond Hill we really focus on bottom-up investing, because we can really look for company-specific opportunities that still look really attractive regardless of what the overall environment looks like.
So this idea that now the markets are anticipating the Fed to start cutting rates in the next several months, who knows how solid that projection is, that doesn't really come into play in terms of whether you feel as if individual companies are valued correctly?
The long-term trajectory of interest rates has a huge implications, of course, for how everybody looks at valuations. And, when you look at the cash flows that a business generates, you have to discount those back to the present to figure out what the company is really worth. And in doing that, you need to know what the discount rate is that you should use. But I really think what we're talking about for next year is a shorter-term potential pause or even decline in interest rates relative to a longer-term trend. And it's interesting that we've seen so much volatility earlier this year, but the volatility has really backed off in the last couple of months, given that most people who are actively investing right now have never invested in a rising interest rate environment until this last couple of years. And so I think when you look at the longer-term trend, we really think that rates, you can look at where rates are now and use that as a reasonable proxy for what longer-term interest rates might look like, regardless of what happens next year.
And where does that bring you in terms of those companies that either they've been left behind in the market this year, which has been animated by this AI excitement and a bunch of secular growth stocks? Although I would say the equal-weighted S&P is up almost 8% year to date. So it's not as if it's been left in the dust. But where in terms of sectors or individual companies are getting your attention?
Yeah, it is interesting. I was looking at some of the valuation discrepancies, and it's not as big as you would expect. But, clearly you have the big 7 tech companies trading at, on average, 27 to 32 times, depending on how you look at it. And if you look at some of those individual companies, they're trading at over 50 times earnings. And so compare that to the opportunity to invest in some more cyclically oriented industrial companies or even some of the companies in the auto parts value chain, where I think you can get them for single-digit PEs in some cases. And that just looks like a really great opportunity for us, for companies that are, fundamental parts of the economy that will continue to do well, even if they do have, some sort of shorter-term blip if we do see a recession next year.
Do you think that it's not just the recession, but any of the auto parts strikes and what the new costs are? Like, there's usually a reason that things wind up at such cheap PEs. Is the market
Absolutely.
just wrong?
Well, so ultimately, I think it's just short term. Yeah. It's absolutely rational in the short term. And if you have a 1-year time horizon, then there's probably a lot of issues you'd want to walk away from. But if you have a longer time horizon, then I think that's really when the opportunity arises. And that's just how we think about it at Diamond Hill, trying to look past whatever's happening in this moment. Yeah.
You mentioned, so these types of companies, and yeah, I mean, the entire auto space is valued as if it's not going to grow anymore, or valued maybe as if there's some recessionary risk priced in there. Do you actually think we're going to have to go through a recession, or is it just going to be this constant concern that it's hovering out there?
I mean, I'm not an economist, so I will not claim to know whether we will definitely have a recession. But I would say that what we look for are companies that have really strong balance sheets, so that if we do go into a recessionary environment, A, they can withstand that environment, and B, they can make the investments that will help them come out the other side much stronger. And I think if you're looking at companies with too much leverage, then the risk is not only they can't make it through the recession, but they certainly won't be able to take advantage of the dislocations that happen in a period like that.
Sure. And what about other areas besides, those types of industrials? What now is looking interesting?
Well, one of the companies we think looks really interesting right now is Texas Instruments. And I think that's an interesting example because it's one where, there's been some slowdown in demand for analog chips, which is really their area of expertise. And that we think that's really short term, that in the long run, secular trends are towards increasing use of analog chips. And TI is making a huge amount of investments in order to try to lower their cost of manufacturing and moving to 300 versus the 200 focus that they and their competitors are using right now, which will give them about a 20% cost advantage, assuming they can implement that successfully. So there's certainly some execution risk, but we think that TI, if you look at some normalized earnings levels, which we think they can recover to as we go through the next couple of years, it looks like a really attractive opportunity.